All right. So last week we talked a lot about the bond market. We dug through fresh mortgage, bond, housing, and macro news. And this week's story is really a continuation of last week. But the data finally followed through, right? Because we talked about bad jobs, better rates. We talked about that a little bit. So inflation actually helped, right? So last week we talked about the bad jobs potentially meaning better mortgage rates. I did say that jobs opened the door, but inflation had to let us walk through it. Well, inflation helped. So that said, we have softer producer inflation, lower oil prices helped bonds, mortgage rates hit 4 week lows. And that's the exact sequence that we've been waiting for. Softer employment, softer inflation, finally some improvement in mortgage pricing. Now we're seeing folks like Barry Habib, MBS Highway. We're hearing Tim Brahim, Loan Alice, where I'm faculty. They're starting to do trainings. Actually, there's one for loan officers on 20th talking about, hey, get your buyers ready for the strike rates, meaning interest rates coming down, opportunities to refinance. So I do want to temper this though. Before anybody hears that I'm thinking 5% mortgages are back, they're not. The economy is starting to tell a little bit of a different story. We've had weak employment, softer inflation, weaker sales, softer consumer sentiment, less expectation that the Fed needs to raise rates again. Reuters reports the softer data actually has reduced expectations for a near-term Fed hike, while Treasuries yields moved a little bit lower, but now a little bit higher. Now we're watching really closely. So we're waiting for things to improve, but know that for mortgage rates to improve, the bond market needs evidence, not predictions. We're getting some evidence, but we're waiting. So look at the 10-year. Here's a reality check. The 10-year Treasury finished right around 4.68 and remains elevated right now. Mortgage rates have, yes, improved a hair, but long-term yields are still high. Government borrowing debt matters in this picture. Treasury supply matters. Inflation expectations matter. And Fed's uncertainty matters. My take on this is simple. This is what I tell people all the time. The Fed doesn't control your mortgage rate. We've literally built the last few podcasts around this. I've had data for the last 10 years on this. Other presentations I've done, blogs, vlogs, X, Y, and Z's, periodicals, right? Now the data is proving the point. So housing is showing the damage a little bit, right? This is where we want to pivot a little bit from our talk on economics to actual real estate, what we do. July existing home sales fell 1.7% to about 4.06 million annual pace. Well, the median existing home price was 434, which is 2% higher year over year, not lower. So it's 2008 prediction, everything's going to crash and chaos, and your $1 million property is worth $50 next week. Yeah, it's not going to happen. We don't really have a housing crash. We do have still an affordability problem. And that's because prices aren't collapsing, transactions are struggling. Those are two different things. Here's where it gets interesting for borrowers. This is a consumer value section, if you will. If you're a buyer today, less competition in a lot of markets, minus San Francisco, because the AI stuff, we talked about that several times now. We're seeing seller credits, price reductions, temporary buy downs, negotiation, inspecting leverage, more time to make decisions. Buy the house you like, not feeling like, oh my gosh, if I don't buy something, I won't be able to buy. Don't do that. If mortgage rates gradually improve, which we anticipate they will, more buyers will come back. So everybody wants lower rates. Remember, with lower rates, more competition. We've seen 30, 40. I actually know of a condo in Oakland in 2022, 75 offers. So would you rather buy the house for $900,000 with a seller credit to get those rates a little bit lower and then refinance later, or wait until rates are lower and potentially buy 5, 10, 15, 30, 40, 75 offers? Don't say one is way spare the next, run the numbers, but I think kind of know the answer to that, right? So the Fed may not do what everyone expects. Here's another development. Reuters poll released today that a strong majority of economics expect the Fed to keep its benchmark rate at 3.5 to 3.75 through the end of 2026. That's a great continuation of your Fed won't save housing. Imagine waiting all year for the Fed to save your mortgage rate and the Fed doesn't even move. Again, mortgage rates still improve without a Fed cut. That's important to remember. Why? Bonds, treasuries, inflation data, consumer spending data, jobs numbers, oil, right? So let's talk about what we're seeing. Conventional offers, we're seeing temporary buy downs. We're seeing non-warrantable condos get escrow. We're seeing high balance financing achieve great results with 10-day closings. FHA, VA, easy to do. Same with down payment assistance. TIC, we've actually ratified 6 TIC offers in the last 7 days. Bank statement loans, we're getting requests from daily. In fact, I just wrote a blog on it today. Debt service ratio, we're still seeing investors looking to purchase property using the income of the property to qualify. Seller credits, we have fast underwriting. And of course, yes, we're still watching the strike rates. So I reached out to all my existing homeowners last week thinking, hey, in the next month or two, which I do believe rates are going to dip a bit, let's be available. Of those folks, I kid you not, 37 of them responded ready to go. And we know these dips happen. Why? Because it's happened 5 times in the last 2 years. Just got to be ready for them. So if you buy a property, know that the opportunity to refinance will likely come. So I'm not waiting for CNBC, Fox, or CNN to announce that refinancing is back. We're watching individual loans. We're watching the market. We're seeing mortgage-backed securities. When math works, our clients know we're going to call them. That's what we do. So don't wait for a headline saying rates are low, because that's usually what's happened already, right? Often it's a week or so after is when they get it. Even though I do write periodicals and I do send them out to several publications throughout California, it's usually data after the data, right? So because by the time everyone agrees rates are good, the market may have already adjusted. So know your number. Maybe someone's current mortgage at 7.25. Maybe they're 6.5, 6.875, different number. Someone buying, completely different calculation. There isn't one magic mortgage rate for America, right? There's not one magic thing that's just everything. No, it's individual. And that's something to remember, right? So 3 weeks ago, we talked about why the Fed isn't going to save housing. Last week, we talked about bad jobs potentially creating better mortgage rates. Now inflation is giving some bonds some help. That's progress. We're not calling it victory. We're watching the data. That's what we've always done. We're watching the bond market. And when the markets create an opportunity for somebody, we act. If you want to find out more, schedule time with me, visit the links below. But thank you for joining us or giving this a listen. Have a blessed day.